Welcome to Dukascopy TV. The Federal Reserve just announced its latest monetary policy decision, and as expected, the Fed kept interest rates unchanged and reduced its QE program by $10 billion. The Fed also kept the term considerable time when describing how long will elapse between the end of its QE program and the Fed's first rate hike. To give his insight into the US market is Bo Jakobsen, Chief Analyst for the US at Nordea. Johnny, how do you feel the FOMC went yesterday?
Well, on balance, I see the Fed signals as once again more hawkish than the previous statements. The actual FOMC statement released just after the meeting was, I agree, slightly on the dovish side, especially on the language on the outlook for inflation. But what I think is much more important is that the Fed also once again lifted its projections for the Fed funds rate, both by end 2015 and 2016. So all in all, I believe the Fed, like we have seen both at the April and June meeting this year, turning more hawkish. So I think the Fed has moved closer to the first rate hike, which is likely to come in mid-June next year, according to the Fed's projections.
Is keeping a low interest rate beneficial for the economy?
I think it is a sign that the U.S. economy has moved away from the crisis mode, and that a more normal cyclical recovery is on track. So I think that is important to remember, and that when the Fed eventually starts to hike rates, it is because the economy has improved significantly.
It seems that the job market is a major concern. Can a call for new jobs really get the labour market back on track?
Yeah, that is quite evident that the Fed is still concerned about the labour market. They still see substantial slack, and as a consequence, they are not overly concerned about the outlook for inflation. But I think, and that is also reflected in the economic projections, that the Fed has been surprised by the very strong labor market figures we have seen this year, and once again they revised down their unemployment forecast, like we have seen many times over the past few years. So I believe this trend will continue, that the Fed will continue to be positively surprised by the momentum in the U.S. labor market, and I think that will also be recognized in financial markets, where I'm still surprised to see that markets continue to price in a much lower Fed funds rate than suggested by the Fed's projections.
Finally, do you think there was anything missing from the meeting?
I was surprised that they kept the considerable time phrase in the FOMC statement. But I think that will disappear, perhaps not in October, but then at the December meeting. But otherwise, I think the overall message from the Fed yesterday is very much in line with our anticipations, and against that background, we still believe that the Fed will eventually hike rates much more aggressively than what is currently priced in financial markets, and as a consequence, we expect to see higher dollar rates going forward, and a further strengthening of the dollar.
Thanks, Johnny. That's all we have time for today, but keep watching Dukascopy TV for more news on the market. Goodbye.